Crypto is going to the moon, but if you're a crypto investor, so is your tax bill. The IRS has collected over $10 billion in crypto taxes last year alone. But here's what's crazy. Most crypto investors would not have had to pay that much if they knew the tax loopholes associated with crypto. So today I'm going to be breaking down the 4 tax loopholes that every crypto investor should know. And number 4 is so powerful, like my jaw literally dropped when I first discovered it. With that being said, let's get right into today's episode. What's up, family? Welcome back to another episode of Tax-Free Living, where I teach entrepreneurs and investors just like you how to legally save thousands of dollars in taxes. I'm your host, Carter Cofield, CPA, and my job is to help you keep more of the money in your pocket and out of the IRS's. Now, before we dive in today, let me be crystal clear on something. Everything that I'm going to be talking about today is 100% legal. This is not about hiding money from the IRS. This is about using the tax code exactly how it was designed to work for you and help you minimize your taxes while maximizing your income. Okay? So with that being said, let's get right into these legal tax loopholes. Loophole number 1, tax loss harvesting. So the best way I could explain this is like, when you think about harvesting, you normally think about farmers, right? If farmers had to harvest their crops in the summer for when they're going to need them in the winter, right? And the same thing works when it comes to our tax loss harvesting for our investments. The concept is, so if I had an investment portfolio, and let's say last year, we had a bad year and my investments had a $5,000 loss, right? So I could sell my investments last year to capture that $5,000 loss, to harvest that $5,000 loss to use it sometime in the future. Now, let's say this year, my investments did well and we had a $7,000 gain. And let's say I want to sell my stocks because I want to use that $7,000. Right? Now, the problem with selling my stocks and getting that $7,000 is I'm going to have to pay taxes on that $7,000 of income, right? But because I harvested $5,000 in losses this year, I can use those $5,000 loss to offset my $7,000 gain. So now I don't have to pay taxes on $7,000. I only have to pay taxes on $2,000. So I can use my harvested losses from the past to offset my gains today. Now, the problem with that is, with stocks, if you sell out of a stock position, you can't buy back that stock for at least 31 days. This is called the wash sale rule. And the issue with that is you don't want to be out the market for those 31 days because the stock can go up in that time period, right? So you have a wash sale rule. So it's really hard to do tax loss harvesting when it comes to stocks. But when it comes to crypto, there is no such rule. So get this, you can literally sell out of your crypto position at noon and buy back that same crypto position at 12:01. So you can sell Bitcoin at noon to capture your loss, harvest your loss, and then you could buy it back at 12:01 so that you stay in the market the entire time. So think about it like this. Imagine you bought a car for $60,000 and it's now worth $30,000, and you being able to claim that $30,000 loss while still keeping the car. And that's essentially what you're doing with crypto. Now, I know some of you might be thinking like, but Carter, if I sell at a loss, aren't I losing money? And the answer is no. Here's the key. Since you're buying back the crypto immediately at the same price you just sold it for, you are not actually losing crypto. You are just harvesting your losses on paper for tax purposes. And this is completely legal. The IRS knows about it and they haven't stopped it. So let me give you a client story on this strategy. So we have a client that's a big crypto investor and he has well over $1 million in his crypto portfolio. Now in 2022, crypto took a major hit and he had losses to the tune of like $300,000. And so what we did is we advised him to sell the position before the year ended so he can capture that $3,000 loss. So he sold $300,000 in Bitcoin and then he bought it back the same day, but he captured that $300,000 loss for his tax return. So last year in 2024, when crypto hit when Bitcoin hit $100,000 for the first time ever, his crypto portfolio had a lot of money in gains. And he wanted to sell out of some of his Bitcoin to use that for another investment. So we recommended that he sell $300,000 worth of his Bitcoin and to use for other investments. So when he sold that $300,000 in Bitcoin, he had a $300,000 gain. Normally, he would have to pay taxes on this $300,000 gain. But because we had $300,000 of losses from 2 years ago, we was able to use those $300,000 losses to offset his $300,000 gains. So he received $300,000 of income, 100% tax free. And this is the power of tax loss harvesting. And if you're a crypto investor, this is something that you must take advantage of, okay? So that's loophole number one. Loophole number two is self-directed IRA. Now, this one is a game changer. So most people know that you can invest in stocks with your IRA. But what most people don't know is that you could also invest in crypto within your same IRA if you set it up correctly. Herein lies the self-directed IRA strategy. So here's how it works. Number one, you need to open up a special type of retirement account called a self-directed IRA. And in this case, I would actually recommend you open up a self-directed Roth IRA. To open up a self-directed Roth IRAs, as you know, with Roth IRAs, you don't get a tax deduction today, but the money in the account grows tax-free forever. So you open up a self-directed Roth IRA, number one. Number two, you move over the money from your bank account to your self-directed IRA. The limit for this year is $7,000. So you move $7,000 in cash to your self-directed Roth IRA account. Step number three, you then purchase crypto in this self-directed Roth IRA. And when you do this, as that crypto grows, you never, ever, ever, ever pay taxes on the gains from any of the crypto in this portfolio. And this is why it's so powerful. And this is exactly how Peter Thiel turned a $2,000 investment in his self-directed IRA to over $6 billion by taking advantage of this self-directed IRA strategy. And you can take advantage of this strategy and put your crypto in there. So as it grows, you never have to pay taxes on the gains. And if you're looking for a company to help set up your self-directed Roth IRA, use our trusted friends at directedira.com. They'll walk you through the whole process and help you set up this self-directed IRA account so you can never pay taxes on your crypto earnings. Okay, so loophole number three, the strategy of the long-term hold. Okay, this one is simple, but it's still powerful, right? So if you hold your crypto for more than 12 months, so 12 months in one day, the tax rates on your crypto dramatically change. So what do I mean? When you hold your crypto for less than 12 months and you sell it, you're gonna have to pay short-term capital gains taxes on the gains from your portfolio. Short-term capital gains rates start at 0 and they go all the way up to 37%. But instead, if you hold your crypto portfolio for 12 months in one day, you only have to pay long-term capital gains taxes, which only range from 0 to 20%. And most people are inside of that 15% tax rate. So by holding your crypto portfolio for 12 months in one day, you can essentially shave 15 to 20% off the tax rate that you would have to pay by simply holding on to your crypto portfolio longer. So if you're in the highest tax bracket and you do this, let's just do an example. So let's say you have $100,000 of crypto gains. If you sell before 12 months, you have to pay 37% tax on that. So that's $37,000 tax bill, okay? But instead, if you hold it for 12 months in one day, your highest capital gains tax rate is 20%. So you only have to pay $20,000. So you get a $17,000 tax savings simply for holding your portfolio for a longer period of time. This is why we encourage our clients, do not sell your assets less than 12 months, because the difference in short-term capital gains rates and long-term capital gains rates is drastic, and you want to make sure you get on the right side of how things work. Now, let's talk about loophole number 4, which is personally my favorite loophole. And like I said at the beginning, my jaw dropped when I found out that you can do this. And this is called the borrowing against strategy. Okay. So this might be the most sophisticated strategy of today, but I'm going to make sure I explain it correctly so that you can know exactly how to do it and exactly what to look out for. So instead of selling your crypto portfolio at any point in your lifetime, triggering a tax event, you can instead borrow against the value of your portfolio and essentially get to use the same dollar twice. Okay, so let's talk about the difference from borrowing from your portfolio for borrowing against your portfolio. This is a very, very important concept to understand. If you borrow from your portfolio, you are taking money out of it and lowering the value of your portfolio. So if we have a $100,000 portfolio and I borrow $30,000 from my portfolio is only going to have $70,000 left in the portfolio. Okay? Lowering the value of my portfolio, lowering the value of my future gains. Instead, if I borrow against my portfolio, so if I have a $100,000 portfolio and I borrow $30,000 against my portfolio, the $100,000 is still in my portfolio. My portfolio still has a $100,000 value, even though I have $30,000 of cash in my pocket. So when you borrow against something, you don't lower the value of the original investment and you don't lower your potential gains in the future. Like, I don't know about y'all, but like this concept completely blew my mind. I said, wait, so I can take money out of my portfolio, but y'all still have it as if I had the money in the portfolio? Like, it was crazy to me. So you don't lower the value of your portfolio when you borrow against, right? Huge concept. Okay, so benefit number 1, your portfolio doesn't go down in value, okay? Benefit number 2, you get to access cash without selling anything. Benefit number 3 is that loans are not taxable, okay? Loans are not taxable, so the money you borrow against your portfolio, it has 0 consequences to you. Number 4, your crypto portfolio stays intact. The value of your portfolio does not change. Now, benefit number 5, right, is that you get to double dip and get arbitrage on the money. So what do I mean? So my portfolio is at 100,000. I borrow 30,000. My portfolio is still at 100,000. I take this 30,000 and use it to buy another asset, right? I use it to buy real estate, right? And so I'm essentially getting to use the same dollar twice because the money is still in my portfolio, but the money is also in this real estate project, right? And think about this, like y'all, when we think about borrowing money in debt, it's all a numbers game. It's all arbitrage. So if I borrow against my portfolio and I have to pay 6% on the money I borrow against, but then I put it into another investment that's getting me 12%, I'm getting to use the same dollar twice and getting a 6% gain on the arbitrage of the investment. And God, I don't know about you all, but like this completely changed the game for me and changed how I look at investing and how I use and maximize my money. So let me bring this point home. We had a client that is a crypto investor and a real estate investor, right? So he had a decently sized crypto portfolio, maybe about $500,000. And there was a real estate project that he was really interested in investing in. So he asked, he needed about $125,000 for the down payment. And he asked, what's the best way to get the money for the down payment without interrupting any of his investments? So we looked at his crypto portfolio and where he had it invested, and the institution that he had it invested in let him borrow against the value of his crypto portfolio. Cool. So we were able to borrow $125,000 from his crypto portfolio, borrow against, not from, meaning his crypto portfolio still had a $500,000 balance. So we borrowed $125,000 from his portfolio, used that on the down payment for this real estate project that he was in, And so now he was able to get invested, buy the building, close on the building, and start to rent out the building. Now, here's what gets crazy. Because the rental property was a investment property, we are able to get depreciation on that investment property. So we were able to do a cost seg study and write off 30% of that, the value of that property, which ended up being about $110,000 tax write-off for the client. So think about this. He borrowed from his crypto portfolio, no taxable event. His crypto portfolio still stays intact. He used the money he borrowed, untaxed money that he borrowed, to buy a real estate property and take advantage of cost seg, take advantage of accelerated depreciation, and get $110,000 tax deduction against his ordinary income. So we got tax-free income, $110,000 deduction, and we kept his crypto portfolio intact and increased his stock portfolio at the same time. This is the power of understanding how to invest. This is the power of understanding how to leverage the tax code so that you minimize your taxes, but maximize your investments. So guys, if this made sense, if you enjoyed this episode, please, please, please hit that like button, smash that subscribe button, and check out other videos on our channel so you can continue to learn how to live tax-free. And I'll see you all next time.